I'm Daniel.
And I'm Mira.
So imagine watching a multi-billion-dollar piece of real estate legislation get, effectively killed and then miraculously resurrected in less time than it takes to hit a drive-thru for coffee.
Yeah, literally less than an hour.
Right. And that was just one 40-minute window of the absolute whiplash we saw on Friday, July 10th, 2026.
It was a day that completely defied the standard market narrative. We saw this intense early morning panic selling that didn't just stabilize, but abruptly pivoted into a really powerful V-shaped afternoon squeeze.
Yeah, driven by just an insatiable institutional appetite for AI infrastructure.
Exactly.
And when you look at where the dust actually settled, it paints a pretty fascinating picture. U.S. equities recovered from those early lows to finish incredibly strong.
They really did.
Yeah, the S&P 500 gained 0.4% to close at 7,775.39. But Nasdaq futures were the real stars,
Yeah.
surging from a steep early dip all the way up to a peak of 30,077.75.
Which is a massive intraday swing.
Huge. We did see Treasury yields tick higher, with the 10-year yield settling at 4.569%, and gold bounced back from its own intraday plunge to close at 4,128.90.
So today, we're going to unpack the mechanics behind that wild ride. We're looking at the shockwaves from the unwinding yen carry trade, the diplomatic and legislative whiplash during U.S. trading hours, and the Fed's latest financial stability check.
Plus a blockbuster market debut for a crucial AI memory supplier, which is huge.
Right. And just a quick reminder before we really get into the weeds, this deep dive is strictly for market context and discussion. It is not personal investment advice or an investment recommendation.
Absolutely. So let's get into session one. What set the stage before the U.S. session? Basically, how did global liquidity and energy flows shape the morning's mood?
Well, if you were sitting at home wondering why your tech ETFs were suddenly wobbling before the U.S. market even opened, the answer traces all the way back to a late-night comment in Tokyo.
Right, the Japanese finance minister.
Yeah, Finance Minister Katayama. At 8:04 p.m. Eastern Time on Thursday, he made some highly consequential remarks urging the Government Pension Investment Fund, the GPIF, to increase their investments in local Japanese assets.
Which is massive.
Yeah.
Because the GPIF isn't just a standard pension fund, right? Like, it is the world's largest.
Yes, the largest, yeah. And the market reaction was instantaneous. The yen quickly strengthened about 0.6%, and the Nikkei 225 jumped 1.38% overnight.
But the reason this matters to a U.S. equity investor is the threat it poses to the global yen carry trade. Let's break down exactly how that works, because it's kind of the invisible plumbing of global finance.
Sure.
For years, investors have essentially been borrowing money very cheaply in Japan, where interest rates were rock bottom. They convert those yen into dollars and then use them to buy higher-yielding U.S. assets.
Mostly U.S. treasuries and high-growth tech equities.
Exactly. And it's a brilliant strategy when rates are static, but it becomes a trap when the dynamic shifts,
Right, because if the GPIF, acting on this government pressure, starts repatriating massive amounts of capital back to Japan, it forces all those other investors to unwind their trades.
They have to sell their U.S. assets to buy back yen.
Exactly. And this creates a very real risk of a systemic liquidity vacuum. Capital flows out of the U.S., pushing Treasury yields up, and those higher yields immediately put downward pressure on equity valuations.
I do want to push back a little on the immediacy of that threat, though. Like, are markets overreacting to the rhetoric? Because the GPIF moving capital is like a massive supertanker, slowly trying to change course in a very narrow harbor.
That's a good way to look at it.
Right. They can't just dump hundreds of billions of dollars overnight without crashing the very markets they operate in. It's a structural shift that takes years, not a trade you execute on a Friday morning.
Well, the supertanker analogy is spot on for the actual physical capital movement, but markets don't wait for the ship to turn.
Fair point.
They price in the trajectory. Modern algorithmic trading front-runs the physical movement of capital. The mere threat of sovereign issuance creating a liquidity vacuum is enough to displace all the liquidity around it. That's why U.S. futures were rattling before the sun even came up.
Yeah, that makes sense. And it wasn't just liquidity making waves before the bell. We also had some deeply contradictory signals on global energy.
Oh, the IEA report.
Yeah. At 4:01 a.m. Eastern Time, the International Energy Agency reported that global oil supply rebounded by 4.1 million barrels per day in June, largely driven by increased transits through the Strait of Hormuz.
The issue there is the timeline, though. The market is basically reading a weather report from last month while standing in a hurricane today.
Exactly.
That IEA report reflects the fragile mid-June ceasefire in Hormuz. But as we know from the prior session's backdrop, that ceasefire officially collapsed during the massive military escalations on July 8th and 9th.
Right. It's completely backward-looking. Though, the IEA did project a forward-looking demand recovery of 1.2 million barrels per day in the fourth quarter, but the supply data was giving a total false sense of security.
Yeah, and while energy was flashing those mixed signals, the geopolitical maneuvering in the tech sector was completely unambiguous.
Oh, wow. Yeah. The 10-cent news.
Right. Late Thursday night, around 10:53 p.m. Eastern Time, reports emerged that Tencent is taking over the AI startup Manus right after Chinese regulators ordered Meta's prior $2 billion acquisition of the same company to be unwound.
Which is just wild. This represents a fundamental shift in how nations view technology. We are seeing sovereign walls being rapidly built around AI assets.
It's the ultimate example of geopolitical ring fencing. It's specifically designed to keep advanced AI capabilities out of Western hands.
And it changes the whole concept of vertical integration, right? It's not just about a single tech giant designing its own chips to save money anymore. Now, entire nations are hoarding their domestic AI capabilities as matters of critical national security.
So if you look at the board heading into the U.S. Open, you have shifting global liquidity threatening to drain out of U.S. equities, a fundamentally tense and disconnected energy backdrop, and geopolitical walls going up in the AI space.
It was a very shaky stage.
Exactly. So that wraps up the morning setup. Let's take a quick break, and then we'll dive into how the U.S. market actually handled all of this at the open. All right, we are back. Moving into session 2. What moved markets during U.S. trading hours? How did markets digest a barrage of political headlines and a crucial Fed report to pull off a V-shaped recovery?
Well, it started with some severe legislative whiplash right after the open. At 9:17 a.m. Eastern Time, President Trump posted on Truth Social, explicitly threatening to veto the bipartisan 21st Century Road to Housing Act.
Which is a huge shock to the real estate sector.
Massive curveball. The sector ETF, XLRE, immediately dipped to 44.05. But then, just under 40 minutes later, the White House walked the threat back, allowing the bill to become law.
That 40-minute window perfectly illustrates how hypersensitive interest rate-dependent sectors are to policy ambiguity. The moment the walkback was confirmed, the XLRE rebounded to close up 0.5% on the day.
It's just crazy how fast that moves.
Right. The algorithmic trading systems price in a worst-case legislative gridlock instantly and reverse it just as fast when the threat vanishes.
But the political headlines didn't stop in Washington. At 10:33 a.m. Eastern Time, we saw a sudden geopolitical re-escalation regarding the Strait of Hormuz.
Yeah, this was tense.
Despite reports that Qatari negotiators were actively on the ground in Iran trying to salvage the ceasefire, President Trump posted that the ceasefire is officially, quote, over.
And in direct response, Iran's parliament speaker stated they are ready for an all-out defense. WTI crude oil immediately spiked to an intraday high of $73.16.
The initial reflex in the energy market is always to treat these geopolitical shocks like unpredictable natural disasters, sudden, destructive, impossible to model. That's why you see that instantaneous spike in crude prices.
But I think we have to look past that initial reflex and view this through a game theoretic lens.
Okay, how so?
Well, this wasn't a random disaster. Dropping that post while Qatari negotiators are literally in the room in Iran that is geopolitical escalation, acting as bargaining leverage.
Ah, I see.
It's a highly calculated move designed to test Iran's defense readiness and force a better diplomatic deal at the negotiating table.
That actually makes a lot of sense. The fact that crude eventually settled back down near $71.49 supports that theory. The oil market initially panicked, but then realized it was watching a high-stakes negotiation tactic play out, not the immediate outbreak of a broader regional war.
Exactly. The market is getting much better at differentiating between terminal escalations and tactical leverage.
But the ultimate sanity check for the day, the thing that really allowed equities to shake off the morning's anxiety, came from the Federal Reserve.
Yes, the stability report.
Right. At 11:01 a.m. Eastern Time, the Fed released its monetary policy report.
And they deemed the U.S. financial system sound and resilient with ample bank reserves.
Which is exactly what you want to hear when the market is wobbling.
Yeah, but the underlying nuance is what institutional investors were really parsing. The Fed explicitly acknowledged that equity and corporate bond prices currently exceed historical averages.
They also flagged rising redemptions in certain private credit funds, right? Which kind of indicates a layer of stress in the shadow banking system.
They did, but the critical takeaway was what they didn't do. They weren't ringing the alarm bells. They noted the high valuations, but they didn't signal any imminent regulatory hammer or aggressive tightening to pop what some might call a bubble.
That hesitation from the Fed over asset prices wasn't just abstract policy, though. It directly dictated the massive influx of capital we saw pour into the market by the afternoon.
Totally. Once the market realized the Fed was just observing the high prices without panicking, the uncertainty lifted. Dip buyers rushed in, comfortable that the broader financial system was stable enough to support these historically high multiples.
Yeah, they looked past all the geopolitical noise and took comfort in the Fed's steady hand. All right, let's take one more quick break, and then we'll dive into the corporate stories that dominated the afternoon.
Be right back.
Welcome back. Moving into session 3, corporate events recap and what to watch next. Basically, which companies proved that the AI capital expenditure supercycle is still accelerating?
Well, if anyone was wondering whether the AI hardware spending spree was slowing down, SK Hynix put that question to rest pretty emphatically.
Oh, absolutely. At 11:36 a.m. Eastern Time, the South Korean memory giant launched its US ADR offering, and the numbers are just staggering.
Yeah, the offering was priced at $149. It opened at $170, which is a 14% jump right out of the gate.
And they saw $200 billion in total institutional demand for a $26.5 billion raise.
To understand why a memory company is commanding that kind of astronomical demand, you really have to look at the physical architecture of artificial intelligence. SK Hynix is a critical supplier of high bandwidth memory, or HBM.
Right, and right now, HBM is the absolute bottleneck for AI processors. Standard memory architectures simply cannot move data fast enough to keep up with modern GPUs.
Exactly. You can have the fastest AI processor in the world, but if it can't access the data it needs instantly, it just sits idle. High bandwidth memory solves this by stacking memory chips vertically, almost like a skyscraper, with incredibly wide data highways connecting them.
It feeds the GPU at unprecedented speeds. And because HBM is so difficult to manufacture, supply is fiercely constrained. If we look at the prior session backdrop, we just saw Micron announce a $250 billion U.S. investment plan to try and catch up.
We've talked before about the concept of AI CapEx acting as inflation now for productivity later. The sheer magnitude of this demand for SK Hynix proves that hyperscalers, the big tech giants, are still aggressively hoarding every ounce of capacity they can get their hands on.
The supercycle has definitely not peaked. And further fueling that cycle, U.S. policy actually stepped in to remove a major roadblock.
Oh, right, the UAE news.
Yeah, at 11:16 a.m. Eastern Time, the U.S. government granted the UAE license-free access to advanced AI computing items.
This is a massive revenue lifeline for U.S. chip designers. By easing those export controls, you instantly open up highly lucrative Middle Eastern markets that were previously bogged down in regulatory red tape.
And the tech sector responded almost immediately, with the tech ETF, XLK, gaining nearly a full percent to close at 185.78.
But the narrative in Silicon Valley wasn't entirely harmonious, Right around the U.S. close on Friday at 4:31 p.m. Eastern Time, Apple filed a blockbuster trade secret theft lawsuit against OpenAI regarding hardware efforts.
Yeah. If SK Hynix building memory chips is laying down the physical train tracks for AI, Apple suing OpenAI is like a vicious legal fight over who owns the blueprints to the locomotive.
Yeah.
We are watching the industry shift from hardware bottlenecks to intellectual property gridlock.
Yeah, like neighbors borrowing sugar turning into a full-blown property line feud. And this introduces significant headline risk, particularly for Microsoft, since they are OpenAI's primary financial backer.
It serves as a stark reminder that while the physical constraints of the AI arms race might be slowly resolving through massive capital expenditures, the legal and IP constraints are just beginning to tighten.
It really was a day of extremes.
Talk about legislative whiplash, right? Yeah. Today, we saw a major housing bill get vetoed and then greenlit in less time than it takes to get through a fast food drive-thru.
Seriously.
Between that 40-minute flip-flop and a geopolitical ceasefire that was declared over while negotiators were still unpacking their bags, It's a miracle the S&P 500 managed to close green.
It really is.
At least we have the SK Hynix debut to celebrate, proving that investor demand for AI memory is far more stable than a political press release. So rest easy tonight. If the Fed says our financial system is sound and resilient, then your portfolio can definitely survive another round of truth social alerts.
Love that. Well, looking ahead to how all of this carries over into the next 24 hours, there are a few key catalysts you need to watch.
It's on the radar.
First, Friday evening at 7 p.m. Eastern Time, we get the Baker Hughes U.S. oil rig count. Given the ongoing headlines out of Hormuz, the market will be heavily scrutinizing domestic supply metrics.
For sure.
Then, on Monday morning at 9:25 a.m. Eastern Time, Fed Governor Bowman is scheduled to give a speech, which could provide more color on that financial stability report. Finally, Monday afternoon at 3:30 p.m. Eastern Time, the Treasury is holding 3-month and 6-month bill auctions,
Which will give us a real-time read on how the bond market is digesting the yen carry trade news.
Perfect.